Hello, Jerry DeMayo from MortgageZoom.com. Let's get right into it to the weekly mortgage rate update. So today, we've seen mortgage rates rally a little bit, getting better for the first time in the last few days. It was a rough week for mortgages, but we've seen mortgage rates start to rally a little bit today. I'm going to bring on Barry Habib. He's going to talk about some inventory problems, some opportunities with rates a little bit higher right now. We are expecting to see rates come down in the next couple weeks, so that's good news. But I'm going to bring on Barry from MBS Highway. Barry Habib.
Morning, everyone. Mortgage-backed securities, they're up 23 basis points. Okay, yay. Did get a hammer pattern at the end of the day yesterday. The market's been so fickle. It's nice to see the 10-year Treasury dipping under 4%. Boy, down so long that it looks like up to us, right? So this is very good sign as we approach next week, where we're hoping to get a little bit better news in the next couple of weeks to help us out here. But let's start off with what we've been mentioning to you, that it does hurt so good to see these interest rates up here, but it can be an opportunity. A home buyer today that's looking at a higher interest rate may get discouraged. But look, if you can qualify, if you get creative by using buy down tools, permanent buy down, you qualify at that start rate, obviously, and then you could bring that rate to a level where they can qualify for more home. You put that individual in a position where they can now get a discount. They can now get a seller contribution to pay for those points for them. This is a very big key because look, let's just use some round numbers here. On a $400,000 mortgage, if you're going to pay 1% higher in rate, that's roughly $257 a month, roughly. Now, that's a little over $3,000 over the course of the year, but there's a high probability that you're going to refinance that. You could probably get a discount on the home that you could use the seller contribution for, 2%, 3% right now in that range. Remember, Case Shiller saying 2.7% drop. So you're looking at an opportunity to purchase that home today. And then, as I want to show you here, inventory is so tight that when rates do come down, remember, for every 1% drop in mortgage rates, 5 million potential buyers, nowhere near that will actually buy, but 5 million potential buyers enter now with the ability to qualify. So this does give a reason to believe that, look, if you believe all the things we've been saying about interest rates coming down because inflation is coming down, lower mortgage rates into sometime later this year, into the summer, there's going to be a lot more buyers that enter the market, and inventory is really tight. I want to show you just how tight inventory levels are. So I'm pulling up a slide here that I want to share with you. We know that the numbers for home inventory showed 980,000 inventory. That was from the NAR. But as we see here, 402,000 of them are currently under contract. Notice the large percentage about this. More than 40% of inventory is already under contract. And what does that tell us? That's actual listings available. Just 578,000. How does that compare? Well, here's where we are. And while it's not the all-time low, which was crazy, and what's happening to prices here, it is half, maybe less than half of what we have been accustomed to as far as listings that people need to purchase a home. You get a drop in rates that we think is going to happen. The time to take advantage of the opportunity is now. So higher rates, while they hurt, it could be so good because this could be an opportunity. This could be your friend.
And Barry, we know the Fed is going to do everything they can to kill inflation, which will in turn bring down long-term rates. So while rates are higher here in the short term, we do expect them to come down, as we've been saying. And we hear from many Fed speakers later on today. And after hearing from Bostic Kashkari earlier in the week, we have a pretty good idea of what they're going to say and how they're going to be talking tough. I want to review some comments from Bostic and Kashkari that we saw earlier this week. So you can see here Kashkari saying, we are in a hot labor market. Now, what's wrong with this? Well, the Fed's looking at the headline job creation figure, the last one showing 517,000 jobs. But we went over all the adjustments and financial engineering and how the raw number was actually significantly negative. He also said it's concerning that rate hikes so far have not brought down services inflation. Well, you know what's included in services and is the biggest component? Housing. And we talked about the reason why that hasn't come down yet in these economic reports like the CPI, but how in the real world, we know that's coming down and there is a big lag effect. And we've talked about how this reminds us of the roller coaster. And you can see shelter costs here, and we've shared this chart before, down to 3%, huge deceleration. Meanwhile, shelter within the CPI still on the upslope of that hill on the roller coaster, but this will catch up. Now, when we talk about Kashkari's further comments, he said, we're not in a recession. Well, of course, what is he looking at? The unemployment rate, which dropped from 3.5% to 3.4%. But we know that the reason why it dropped was, again, population controls and all of those adjustments. But also, they make the mistake of believing that you can't get a recession when the unemployment rate's low. We've also shared this chart with you where every single time recessions start when the unemployment rate reaches its lowest point and begins to turn higher. He also said if we declare victory too soon, there will be an outpouring of exuberance and we'll have to do even more work. What he's saying here is he's afraid to make another mistake. You see, Kashkari, Bostic, these individuals were amongst the most dovish. They were begging for inflation, not worried about it. And now, after making that mistake, they're afraid to make another mistake, right? And they don't want their legacy to be that. However, I would argue they're going to make an even bigger mistake here by going too far, too fast, and sending us into a recession. Now, it's also important to note that, the Fed, by doing that, will actually help the economy slow down and will help longer term rates come down in the future.
Yes, Dan and Megan, the parade of Fed speakers today, let's go through who they are.
Yes, we're going to hear from Lori Logan, the Dallas Fed president, Michelle Bowman, the governor, and Thomas Barkin, the Richmond Fed president. And then we're going to hear from Raphael Bostic again. And here are some more quotes from Raphael Bostic for the third day in a row. He wants to cause pain, and it's sad. He comes out and he says, we will need to see monetary policy have a greater dampening effect on demand, slower wage growth, before concluding that inflation is moving steadily lower. Listen, they didn't see the signs of inflation in the beginning, and now they want to inflict pain, which you can see by this next comment. The policy rate will have to stay at that level well into 2024. But here's the thing, team, this could change in a matter of seconds if we start to see the economy contract. And we might get some news regarding that next week. We're going to hear from Powell, which I will be very curious to see if he follows the same kind of language as these individuals that we've heard from today. And we're also going to get some auctions, a 10-year auction, a 30-year auction that could be market moving. But the biggest news next week is it's finally jobs week. And listen, we've been waiting for this data. Starting off on Wednesday, we're going to get ADP, where they're estimating 185,000 job creations. And then Friday is going to be that big BLS jobs report, where they're estimating 200,000 job creations and for that unemployment rate to remain at 3.4%. We would not be surprised to see this come in worse than expectations.
Yeah, Megan, agree. That's what we're waiting for. So hopefully, and credit to Financial Juice's Twitter feed there, where we were able to take a look. He took down some of those Fed statements as they were coming out in real time. Want to say, let's take a quick look here at the markets. And we are up 28 basis points right now, which is a good thing. Thank goodness. We see that the 10-year Treasury has dipped below 4%. Here's the 10-year Treasury here. If this were to close right here, this would be a bearish engulfing pattern and suggest lower prices ahead. But there's a long day ahead of us. So let's see. We take a look at mortgage-backed securities. We did have a hammer yesterday, and that's so far so good. These 3 days would be a bullish morning star pattern. It is the opposite of what you saw right here. And you can see that from very overbought levels. What it led to was a big downturn. Now we're very oversold. Can we potentially close here and lead to a meaningful improvement? This is what we were hoping for and waiting for, to see a potential bounce. And it's really going to be very dependent on the jobs numbers next week. And then following week, we'll get that CPI number. We hope both are friendlier because the markets are ripe for a reversal with just a little bit of help. We'll see if we can get some improvement, begin the day floating.
So what Barry said is next week we're expecting to see rates, listen, with some good news on jobs. And when I say good news, that means less than expected jobs numbers. We're expecting to see rates start to improve. So let's look forward to a good week next week and see rates continue to rally and see some improvement. So if you have any questions, go to www.mortgage-zoom.com. You can schedule your one-on-one appointment with me, Jerry DeMeo. And don't forget to like this video. Don't forget to subscribe to the channel. And thank you again. And we'll see you next week.